Good morning. Marc Ostwald from ADM ISI with some thoughts on what's been going on over the month, above all with a particular focus on US credit markets and US government bond yields. So on our first chart, what we have is the US 10-year yield, and as we can see from that peak back in November, around about 325, we have actually fallen more than 100 basis points now to 218. Obviously, the big trigger for the latest move has been Donald Trump's threat to use tariffs in the immigration war with Mexico, which doesn't send a fantastic signal. However, we need to keep this a little bit in perspective. Yes, the flight to safety flows are more than understandable, be it into US Treasuries, be it into the Japanese yen, the dollar, and the Swiss franc. We are now at a stage where we have 10-year yields below the bottom end of the Fed funds target corridor, between 225 and 250, and we need to get some signals once the trade concerns and the flight to safety flows have started to ebb, that actually there is going to be some action from the Fed, because the market at the moment is discounting, and that's fully discounted in this US 10-year yield, a cut in US interest rates, or two cuts in US interest rates by the end of Q1 of 2020. But the Fed narrative at the moment is the economy is generally in a good place, and it expects the current weakness that we're seeing in inflation indicators to be transitory. Therefore, at some stage, we're going to find that this is a very overcrowded trade. So how's this played out in terms of credit markets? I think that's the key place to look. What we saw, so if we go to our next chart, what we've seen over recent weeks, so basically since the beginning of May, is a steady widening in credit spreads. A lot of that widening, one would have to observe, is actually as much more a function of the fall in US Treasury yields rather than a big rise in credit yields. But nevertheless, this is a significant move. It's obviously not of the sort of scale that we saw in November and December, but this, along with some of the other credit spread charts, which we'll go through, is certainly signaling a tightening of financial conditions, and that is one thing which could be a trigger, particularly if we continue to see more volatility in the S&P 500 for the Fed. If we turn to the next chart, what we're looking at is the US high yield average bond spread. Again, here too, we're starting to see quite substantial widening, obviously not to the wides of back in December, but nevertheless a very substantial move. And those people who charged back into credit at the beginning of the year are probably starting to feel uncomfortable. And indeed, we're seeing evidence of that widening in spreads also in the Lipper fund flow data that we get every week. Yesterday we had the latest reporting week, investment grade credit flows, outflow of $5.076 billion. That's the biggest since 2015. High yield funds minus $1.27 billion. And equity funds, this is both ETFs and mutual funds, seeing a whopping $21.976 billion outflow. Interestingly, if you tot all those numbers up, we're obviously looking at a number somewhere in about 28 billion, but that's not necessarily being matched by inflows into money market funds, 17.525 billion. So the suspicion here is that perhaps people are starting to liquidate positions which have been generally favorable to cover losses in other instruments, and that may also be contributing some of the falls that we're seeing in some of the commodity markets, particularly oil. My final chart is the US emerging market bond spread, and this too has seen some widening, and this is really where the main pressure will come. If the dollar continues to strengthen, then we will start to see some further, more significant widening of the sort of order that we saw at the back end of last year, and indeed for much of the second half of the year. And that will start to create some problems for some of the emerging market central banks.